Welcome back to the channel. Today, we're diving deep into a topic that has sparked countless debates in the crypto community: how Bitcoin was corrupted. We're gonna break down the evolution of Bitcoin, from its idealistic beginnings to its current state. We'll explore the forces that have shaped its journey and uncover the truth behind its transformation. Get ready to explore the intricate world of mining pools, exchanges, and the impact of speculation. We'll also discuss the emergence of Bitcoin forks and their implications for the future. This is a story about technology, finance, and the delicate balance of power. Make sure to stick around till the end for some surprising insights. Chapter 1. The Genesis of Bitcoin, a Vision of Decentralization. Let's start at the beginning. Bitcoin was created in 2009 by an anonymous person or group known as Satoshi Nakamoto. It was designed as a decentralized currency, free from government control and manipulation. Imagine a world where financial transactions could occur directly between individuals, without the need for intermediaries like banks. That was the promise of Bitcoin. The idea was revolutionary: a peer-to-peer electronic cash system that could empower individuals and challenge the established financial order. It was a vision of financial freedom where everyone had equal access to the network and control remained distributed. Early adopters were drawn to Bitcoin's decentralized nature. It represented a break from traditional systems, a way to opt out of what some saw as a flawed and unfair financial landscape. Transactions were transparent, recorded on a public ledger called the blockchain, and secured by cryptography. This ensured accountability and trust within the network. But the path to revolution is rarely smooth. As Bitcoin gained traction, it attracted attention from various players, each with their own motivations. Miners, individuals who validate transactions and secure the network, started forming pools to increase their chances of earning Bitcoin rewards. While this seemed like a practical solution, it inadvertently paved the way for centralization. The rise of powerful mining pools shifted the balance of power, concentrating it in the hands of a few. This development contradicted the very essence of decentralization that Bitcoin was built upon. It raised questions about the network's vulnerability to manipulation and control, concerns that continue to fuel debate today. So, while the initial spark of Bitcoin was one of decentralization and empowerment, the journey was just beginning. The stage was set for a clash of ideologies as various forces converged, each seeking to shape the future of Bitcoin. Chapter 2. The Consolidation of Power, the Rise of Centralization. As Bitcoin gained popularity, mining became more competitive. Remember those early days when anyone with a computer could mine Bitcoin? Yeah, that didn't last. The increasing complexity of mining algorithms demanded more computing power, pushing individual miners out of the equation. Large mining pools emerged, consolidating resources and hash rate. These pools became dominant players, wielding significant influence over the network. We're talking about massive operations, often located in regions with cheap electricity. Think about it. A handful of entities controlling a significant portion of the network's hashing power. That's a long way from the decentralized vision Satoshi Nakamoto had. This shift towards centralization raised concerns about the original ethos of decentralization. The very thing that made Bitcoin unique, its distributed nature, was being challenged. This concentration of power meant that decisions regarding Bitcoin's future could be influenced by a select few. Imagine a scenario where a single mining pool or a coalition of pools could potentially control the confirmation of transactions. They could, in theory, censor certain transactions or even double-spend Bitcoin, undermining the integrity of the blockchain. While these are extreme scenarios, the possibility itself raises red flags. The centralization of mining also had implications for network security. A single point of failure became a real concern. If a major mining pool were to be compromised or experience a shutdown, it could disrupt the entire Bitcoin network. This chapter highlighted the growing pains of a nascent technology grappling with its own success. The influx of players and the pursuit of efficiency led to compromises that chipped away at the core principles of Bitcoin. The question remained: could Bitcoin reclaim its decentralized roots, or was this shift in power inevitable? Chapter 3. Gatekeepers of Cryptocurrency, the Influence of Exchanges. Next, we have cryptocurrency exchanges. These platforms act as gateways to the crypto world, allowing users to buy, sell, and trade Bitcoin and other digital assets. They provide liquidity and convenience, making it easier for everyday people to participate in this new financial landscape. But while exchanges play a crucial role in the crypto ecosystem, they also introduced vulnerabilities. Think of them like the central banks of the crypto world, holding vast amounts of user funds. This makes them prime targets for hackers and cyber attacks. And let me tell you, the history of cryptocurrency exchanges is riddled with hacks and security breaches. We've seen exchanges lose millions, even billions of dollars worth of cryptocurrency to sophisticated attacks. These incidents erode trust and highlight the vulnerabilities of centralized platforms. Beyond security risks, exchanges also face regulatory pressures. Governments around the world are grappling with how to regulate this emerging asset class. Some embrace it, while others impose strict rules or outright bans. This uncertainty creates a challenging environment for exchanges to operate in. Then there's the issue of KYC/AML compliance. To prevent money laundering and illicit activities, exchanges have to implement Know Your Customer and anti-money laundering procedures. This often involves collecting personal information from users, which some argue contradicts the privacy-centric principles of cryptocurrency. Furthermore, exchanges can exert influence through listing decisions and trading fees. The power to list or delist a particular cryptocurrency can impact its price and accessibility. Similarly, high trading fees can eat into investor profits and create barriers to entry. So, while exchanges provide a valuable service, it's important to acknowledge the trade-offs. They introduce centralization, security risks, and regulatory hurdles that can undermine the very foundation of Bitcoin. The challenge lies in finding a balance between accessibility and the preservation of core principles. Now let's talk about the elephant in the room: speculation. It's no secret that speculation has played a huge role in Bitcoin's journey. Initially envisioned as a revolutionary technology, a peer-to-peer electronic cash system, Bitcoin quickly became a hot commodity, attracting investors seeking to capitalize on its price volatility. This shift in perception from technology to investment vehicle has had a profound impact on Bitcoin. It's fueled massive price swings, creating both fortunes and devastating losses. Remember the 2017 bull run? Bitcoin skyrocketed to almost $20,000, only to crash back down in the following months. This volatility attracts traders and speculators looking to make quick profits, but it also creates an environment ripe for manipulation. We've seen instances of pump and dump schemes, where groups artificially inflate the price of Bitcoin to lure in unsuspecting investors, only to dump their holdings and profit from the subsequent crash. This speculative frenzy overshadows the real-world applications and potential of Bitcoin. It shifts the focus away from its use as a medium of exchange or a store of value and turns it into a mere trading instrument. This can deter businesses and individuals from adopting Bitcoin for its intended purpose. Moreover, the constant focus on price fluctuations can lead to emotional decision-making. Investors driven by fear and greed are more likely to make impulsive choices, buying high and selling low, further exacerbating market volatility. It's important to remember that Bitcoin is still a relatively young technology. Its long-term value proposition remains to be fully realized. While speculation is an inherent part of any emerging market, it's crucial to approach it with caution and a healthy dose of skepticism. Don't get caught up in the hype. Do your own research, understand the risks, and invest responsibly. The future of Bitcoin depends on its ability to transcend its speculative nature and fulfill its potential as a transformative technology. The Bitcoin story wouldn't be complete without talking about forks. Forks are essentially software updates for the Bitcoin protocol. Think of them like software updates for your phone, but with much higher stakes. Sometimes these updates are contentious, leading to disagreements within the community about the direction of Bitcoin. And when these disagreements become irreconcilable, the Bitcoin blockchain can split, creating a fork. This results in two separate blockchains, each with its own set of rules and its own version of Bitcoin. The creation of forks like Bitcoin Cash has further complicated the landscape. These splits reflect differing ideologies within the community. Some believe that Bitcoin should prioritize scalability and become a widely used payment system, even if it means increasing the block size and deviating from the original vision. Others argue that Bitcoin's value lies in its scarcity and security, and that increasing the block size would compromise these principles. These fundamental differences in vision have led to heated debates and ultimately to the creation of forks. While forks can be seen as a sign of a healthy and evolving ecosystem, they also introduce uncertainty and fragmentation. For new users, navigating this landscape can be confusing. Which Bitcoin is the real Bitcoin? Which one should they invest in? Forking also dilutes the network effect of Bitcoin. Instead of having one unified blockchain with a large user base, we now have multiple chains competing for attention and hash rate. This can slow down development and hinder adoption. The debate surrounding forks highlights the challenges of governing a decentralized system. Without a central authority, reaching consensus on major changes can be difficult. This inherent tension between different visions for Bitcoin is likely to continue to shape its evolution in the years to come. So, what does the future hold for Bitcoin? That's the million-dollar question, or should I say the potentially multi-trillion-dollar question. We've seen how Bitcoin has evolved from a fringe idea to a global phenomenon, grappling with issues of centralization, speculation, and internal divisions. Will Bitcoin ever truly achieve its initial vision of becoming a widely adopted, decentralized currency? Or will it remain primarily a speculative asset, subject to the whims of the market? These are questions that only time will tell. One thing is for sure, Bitcoin has sparked a revolution. It's challenged the established financial order and ignited a global conversation about the future of money. Whether it ultimately succeeds or fails, its impact is undeniable. As we move forward, it's important to approach Bitcoin with a critical eye. We need to acknowledge both its potential and its limitations. We need to be mindful of the forces that seek to control and manipulate it. And we need to engage in thoughtful discussions about its future. The future of Bitcoin is not predetermined. It's being written every day by developers, miners, investors, and everyday users. It's a collective effort, and the choices we make today will determine the path it takes. So stay informed, stay engaged, and let's see where this wild ride takes us. So, we've gone pretty deep down the Bitcoin rabbit hole. From its origins as this decentralized dream to the realities of mining pools, exchange influence, and the constant pull of speculation, it's clear that Bitcoin's journey has been anything but straightforward. It's easy to get caught up in the hype, the price swings, and the promises of quick riches. But I think it's important to step back and appreciate Bitcoin for what it is: a technological experiment, a social movement, and a financial asset all rolled into one. Whether you're a die-hard hodler or a skeptical observer, there's no denying that Bitcoin has sparked a conversation that's going to continue for years to come. It's up to all of us to decide what the future of money looks like.